We heard many interesting facts and figures in today's session, confirming that families and their wealth are moving around the globe. One thing is for sure, wealth is fluid and it can literally go anywhere. Obviously, as long as your taxes are up to date and you meet the FICA requirements, that is. This consistent trend provides us with endless topics to discuss and many opportunities and challenges when advising our clients. One thing is for sure, it is becoming more onerous to advise global families on wealth transfer, wealth preservation, protection, and transfer. Intergenerational wealth transfer is becoming a very common term. It's one of those suitcase terms that we are hearing today when advising wealthier clients with a global family footprint. But what does it really mean? Because everybody's saying it. But I went and I asked the AI companion and used Copilot, and I don't think there's any surprises to the definition that it came up with. And it's basically the process of passing assets, property, or financial resources from one generation to the next. So parents or grandparents to children or grandchildren. So before I unpack this topic, I would like to share some interesting stats regarding intergenerational wealth transfer that is currently being referred to as the Great Transfer, as a backdrop to our discussion. The UK Times published in December last year that 5.5 trillion wealth will be transferred in the next 3 decades. Investopedia in November estimated a transfer of $84 trillion being transferred by 2045, which is literally less than 20 years from today. And in ING.com in October 2025 estimated 3.5 trillion euros being transferred in the next 5 years. So to help me unpack these numbers and what wealth transfer will look like and what we should know about it is Madeleine Schubert. I would like to welcome you back to Global Citizen.
Thank you so much, Sharon.
Madeleine, I'm sure that you're already seeing proof of this great transfer that people are referring to in your business with the type of clients that you're working with.
Yeah.
Maybe give us a couple of examples or trends that you're picking up at the moment.
No, it's definitely becoming a reality, and the amount of wealth that is being transferred is actually phenomenal because it's the baby boomer generation that's now moving on slowly. And often of them also just have 1 or 2 kids. So you have this massive wealth transfer often going to 1 or 2 kids. And if you don't plan, obviously now, all that wealth can be lost. So it's become a reality.
Yes, I think maybe something that you probably have discussions on even more often than we do is when should people transfer the wealth? So if you start with this whole process, we should typically have a discussion with the client during their lifetime and say, are you going to transfer the wealth now whilst you're alive, or are you going to wait until you have died? And typically, I think people wait until death because they are adverse to paying taxes and they're also probably not too keen to let go of the control over the assets that they've got.
Yeah, they're very true. So the baby boomer generation is all about control. So they also the way they run businesses. I'm the boss. It's my way. Where the new generation is, of course, different. So there's a huge hesitation to let go of control, and then obviously paying taxes is another big matter. So that's definitely coming through. But in the same time, I have a few clients that's there's a Chinese philosophy that says share while you're alive. So you can get the benefit to the children now because often they need the money now because they're having children. And school fees and all those obligations does have a play. So I do see a trend of a middle way, but using trust structures as opposed to a direct passing of ownership. But it's also, again, jurisdiction dependent. Because in some jurisdictions, you rather transfer, for example, in UK, you will transfer assets within the 7-year period, where in South Africa, probably will look at a trust structure. So it's complex. Complex.
I think maybe the true purpose of financial planning is sometimes just giving the clients the information so that they can make an informed decision.
Correct.
And sometimes the decision will be not to do anything because that works for them.
Correct.
And then sometimes it's to put the structures in place, and other clients just give the money across. But I suppose there's no right or wrong answer, whether they do it during their lifetime or during their lifetime and death or only upon death. I suppose we can plan for all of those instances.
No, 100%.
If we look on death, obviously some people will say, well, maybe it's a bit better because you get the abatement from an estate duty point of view. But if you're talking ultra high net worth clients, those amounts do not really matter, because if you've got 500 million in your estate, getting 7 million rand as a tax-free amount is really not going to make any difference. And that is where I thought maybe let's do a comparison, a very simple comparison, to see how sweet is the proof in that pudding. Basically assume that we've got a client that's got 100 million rand invested today. Forget about all the other assets. And I said, okay, let's assume they transfer 100 million into a trust today by way of a donation, so not using any interesting structures at this point or Section 42s or whatever. So we've got the 100 million cash. We're going to move it into the trust today via donation, or we take the same 100 million, but we keep it invested, and then it will go 10 years from now on death of the client. And we assume an 8% rate of return. So I did some Excel calculations, no brain surgery. For those of you that are interested, the calculations will be on the download tab on the platform. So you can go and have a look at it if you want to. So if we look at the calculations, and please don't try and look at all the numbers because it looks fairly busy. But in summary, it basically shows us that donations tax, if it's paid today versus when the client dies 10 years from now, will be 57% of the estate duty payable 10 years down the line. So that's 43% less. Capital gains tax payable now, I assume the base cost of 50 million for the investment, will be 23% compared to the capital gains tax payable upon death, which is quite a substantial difference. Effective wealth transfer today will be 70 million after tax into the trust. And if we compare the value 10 years from now, it will be roughly 143 million. Where if the client dies and then only bequeaths it to the trust, and after the estate duty and the capital gains tax at that point, it will be 136 million. So it's 7 million difference, which is probably not great, but there is a financial benefit in perhaps doing it sooner rather than later. So it shows that the client that is making the donation today will pay 40 million rand less in taxes and nearly 4 million less in admin fees. So from a quantification amount, 44 million rand is quite a lot of money. But, Madeleine, just as you said before, clients do not necessarily like paying taxes when they're alive. So some of them will say, I'd rather pay it later.
So it's interesting because it comes back to the philosophy. So once again, it's about the control, and we can see the logic in the numbers, but it's not always there. So reality is what often I see in practice happening with clients, especially older clients, especially if they live in South Africa, they can understand and they will look at your numbers and they will appreciate your numbers. But then at the same token, if they did a donation to the children as opposed to a trust, their biggest fear is whether the children will come to the party if something happens to them, because longevity is also reality. So if you dispose of all your investments and you have a personal crisis, how would you get money back? Because you're not going to recover that fund. So often maybe the way is it's half of that. So from a financial planning perspective, you probably want to see your potential spending and work out your potential life expectation, get a number, and work out the next gen money above that threshold.
Yes.
Because that's really what you want to transfer to a trust or similar structure, and then dispose of that based on your numbers. And that will be smart planning from my perspective.
Yeah, so the money that you really know you're not going to need during your lifetime, you will transfer it.
Correct.
I don't think there's a right or wrong answer. I think maybe the message is that when discussing investment and investment options, often advisors are focused on what do we do with the money, where do we invest it, in what vehicle are we going to do it, but we have to consider what's going to happen later.
Correct.
And we should at least show them what the impact is, doing some of it now, doing some of it later, considering longevity and what the needs are.
100%. Is also the different asset classes that you have, because you have, for example, your pension funds annuity stream, and you have your properties, and you'll have your passive investments. So it could be quite a interesting, it's not a straightforward answer. If you've got 100 million cash, then it's an easy equation. But often it's made up of different asset classes. And one will then consider different structures to house those classes in. So property is one strategy. Cash is another strategy. Your pension fund is another strategy. And then looking at the recipients and their needs, because you'll have one child that might need special attention and because they might be a spendthrift, where we have another child that's maybe more money savvy or want to start a business. So it becomes quite a discussion with the family, and you actually need to become the business partner in a sense to walk the road.
Yeah. Just on that, I once attended a session where one of the family office type advisors in the US had a discussion, and I think it's becoming more and more prevalent even in South Africa, that you have to look at the entire family and nearly include all of them in the discussion, which I think a lot of the baby boomer clients that you refer to are still a bit averse to, because they like to keep their cards quite close to their chest sometimes.
No, that's a reality. I mean, I've had a client now, the dad built up a massive trust, a massive underlying property, and died. And then suddenly the children had 4 grown-up children, all in their late 50s, 60s. They were left with this trust, was not aware about anything. So now they don't know how to run a trust. They don't know how to deal with the investments. In fact, they're a soft target now because there's a lot of financial advisors that maybe not the best advisors that's approaching them. So now they're trying to work out how to work with this type of wealth and keep it. Because if you don't know how to deal with property investments, passive investments, you will lose your money overnight.
Yeah.
So you got to start trusting.
Yes, and you have to bring people in to understand what the decision making was.
Correct. And also, I mean, your top tier wealth investment client, they often have their team, but it's actually the tier below it. Let's call it your high network client, but not quite your ultra wealthy. They often don't have a plan. So, which might have larger pension funds, maybe some assets. So that tier seem to be a little bit lost, and they're the ones that needs more attention at the moment.
Yeah, I think definitely advisors should have the discussion and try to sensitize clients that we have to include with there's future wealth. Rather get the kids involved now while they can learn from you, rather than just dump it on them eventually.
No, 100%.
If we consider trusts, had a whole trust discussion earlier with Lauren and Eugene as well, considering whether trusts are really for all clients, which we obviously know it's not, because some of them just don't like the relinquishment of control and all the admin that goes with it. But if obviously a large segment of the market are using the offshore trusts, I just maybe want to recap again for our advisors to remember the funding options that are used versus the tax implications attached to it.
Okay.
And you always explain it that even I can make sense of it. So it's fine. Maybe just give them a lowdown of all the taxes that they must consider when doing an offshore trust and deciding where most clients will probably not want to part with the donations tax, using the loans, the interest-free or low-interest loans, and what the tax consequences would be for the local investor in that case.
Okay, 100%. So, I mean, in the local and offshore space, if we look at trust, there's obviously different funding mechanism, but the most basic one is, actually the most two basic ones is making a donation, which will trigger donations tax. And if you dispose of an asset, you will have potentially capital gains tax, right? If you don't want to pay the donations tax, then you will cede the asset or cash, or you'll make a loan and to the trust. So there's a loan account due to you. Now that loan account can be interest bearing or not. If it's not interest bearing and it's a local trust, we've got a Section 7C event. Section 7C basically tells us every year, because there's a lack of interest, you deem to pay donations tax, which is calculated as 20% of the official rate of the capital amount. Over and above that, there's an income tax event as well, and this is what they call attribution. Now, when you make a donation to a trust, and a trust received as funds, then the money in a trust gets invested. And now, if it's invested in a way that we call naked investments, then all the income and capital gains that arise in a trust needs to go back to the donor. And that's in the case of a donation or a low interest or zero interest rate loan. So it goes back to the donor. Now, in practice, for South Africa, it's not necessarily a bad thing, because often the rate for the individual is lower than a trust. So we like attribution. Locally, we like the attribution to play, because a trust marginal tax rate is 45% income tax and 36% for capital gains tax, where for individual it's 18% capital gain. Okay, marginal rate can be the same, but at least it can vary as well. So from a local perspective, attribution is nice, but the only thing that's going to hurt you is your 7C donation. So you've got to often play between the different loan accounts to local trusts, whether it's interest-bearing, no interest, or a combination thereof, because you can do the sums and you'll find kind of what we call a sweet spot. So you play with a different type of loans. Offshore is a different ball game, because offshore, the trust got no tax liability. So there we don't want attribution, because now we're going from a tax-free spot or jurisdiction to making something taxable.
Okay.
So there we don't want attribution. So for those offshore interest-free loans, they are very tricky, because we've got two sections coming into play. So if you have an offshore loan, there is transfer pricing and Section 7C that's applicable. And then whether both or one is applicable is absolutely dependent on the amount of interest that you charge, and the amount of interest is then geared towards the currency of that loan.
Okay.
So the
official rate will be the one that's in that currency.
Correct.
Similar.
Or similar rate. And so similar than our official rate, that side. So if you're on official rate, most of your time you don't have a problem. And most of the time you'll get into keep the transfer pricing also happy.
Okay.
But if the transfer pricing rate is market related rate, and in the transfer pricing world, we don't have what we call in South Africa a safe haven. If you want to work out what's market related, you need to test it as if you're the bank. So if a bank is going to lend you money, they want to see what is their risk profile.
No.
So a bank will lend you money, but then if you're high risk, they're going to rate a higher rate. Exactly. If you're low risk or there's security, the rate will come down to, let's call it prime or less. So then it depends on how risky this is. Now that's a test that you need to do for market related.
For transfer pricing.
Correct. So you need to do some sort of benchmarking, and more you'll see, even when most over cross-border transactions, the banks want to see your transfer pricing policy. So it's important that you do that test. But normally, and it's not a safe haven and it's not an absolute, but normally if you tend to stick to your official rate or equivalent, you tend to be fine.
Okay.
Is this if your market related is higher, then the new Section 7C would push you up. There was a recent amendment, so it will always be, if you apply a 7C rate and your market relate, the rate is actually lower.
Yeah.
Then you're compliant to transfer pricing, but 7C will want to collect a little bit between the transfer pricing rate, the market related, and if the official rate is higher, 7C is going to want to collect adjustment there, a donations tax there. So it's a very complex area so you need to know what's the official rate, you need to know the market related rate, you need to compare those two rates and then decide where do you fall. And to be safe, you must always try to be the official rate, provided it's a little bit higher than the market related rate. It's complex.
So what I'm
complex, yeah. Okay.
Is you can't give advice on this on your own. You need to consult with a tax practitioner or specialist that's got offshore and transfer pricing experience.
Yes.
If you're using these structures and loans are involved.
Correct.
And the client can then face 7C, transfer pricing, and obviously attribution and rules that can come into effect. So it can actually come back to bite them if it's not done properly.
It must be done correctly. So, and it's very complex for the nature of being offshore. If it's done correctly, you will pay income tax. And often as a funding mechanism of a loan or donation, depending which route you go, the clients don't like that. So then they will rather look at alternatives.
Yeah.
And that's where your freezer and that type of trust will come into a better position, because then it's more about creating a trust now, and on death you do the transfer to the trust. So the next gen will benefit and you don't have that harsh income tax that you have. So it's a bit of a situation where you, the person with the money, need to decide whether you will suffer the income tax or do you structure for your benefit and the children will get what's left. So there's definitely a bit of a stress between the two pots.
Once again, the advice is to give them both sides of the coin and then decide which one they want to.
And it doesn't be all or nothing. Sometimes it's a middle way. So you can put different strategies in. You can have a inter vivos trust, you can have a freezer trust, and you can have someone in your own. And you can have, obviously, then your products can also play into that, your endowments and all those things. So you could have a nice collection of different options that works together. That would be more holistic.
Softens the blow.
It softens the blow and it's holistic planning, and it is a measurement of control.
Okay.
Yeah. But
Madeleine, for the client, and also I know we can spend probably an hour on this discussion because there's other funding mechanisms. You can put a company in the middle. We can do share issues, and but that's maybe a discussion for another day. Just looking at succession today, which is our main topic. How do we get the wealth from one generation to the next? Where we've got the client that has already got assets abroad, so it's quite cumbersome for them to move it across into the trust now. So we will touch on the freezer trust again just now. But they have to make provision for succession today. From your experience, would you do a single will or would you do different wills in different jurisdictions? And I know the other day you mentioned Brussels 4. I'm saying it as if I know what it means. But maybe just share with our advisors what they should take note of for the clients that have got assets across the world. They need to make plans for immediate succession for today. No structures in place or limited structures being used at this stage. From a will point of view, what would you suggest?
Yeah, so and I think we discussed it before, there's no right or wrong answer. So you could have one will, worldwide assets, but it gets complicated because if you have assets in, especially fixed property in different countries, then you have got to go through quite a lengthy process of probate to get that will endorsed in South Africa, recognized in a different jurisdiction. It becomes a long story. You will have your estate being wound up for many, many, many years.
Okay.
Alternatively, so rule of thumb, normally when there's a fixed property in another jurisdiction, my advice always been do a will just for that jurisdiction. And that would be smart.
For that property.
And then if that jurisdiction happens to be in a civil law country, your Cyprus, your Portugal, Germany, France, all those civil law countries, then you can, if your habitual abode is in South Africa, you live in South Africa, but you happen to have a property there, then you can make election on Brussels 4. Now, Brussels 4 is an EU regulation. It allows us as South Africans, and actually the whole of EU, to say, I choose my country's law to apply to my assets.
Okay.
Which means our freedom of gestation and to whom we want to transfer property will apply, and not that civil law jurisdiction of, for example, Portugal. We override the legislation.
Just for our viewers that don't know, civil law jurisdictions literally prescribe how assets must be.
So, and then it's also always controversial. Civil law jurisdiction prescribe how your assets by law needs to be bequeathed and inherited. So you can't basically disinherit any child. And it goes not just at assets, it goes to policies as well. Where as South Africans in common law jurisdiction, we have freedom of gestation. We can decide to disinherit our children or not, which would sometimes happen. So and it's the two systems are what's fair and just. Some people say freedom of gestation is nice, it's your right, it's your asset. Civil law people believe that you chose to have children, so you should leave something for them. So it's that. I'm not going to say what's wrong or right.
No. But at least they've got a choice now.
Correct. But it's interesting. So, I mean, the Brussels 4 makes a huge difference. But what I also came in practice the other day, I had a client that had Cyprus properties. So we did a will for them, and applying the Brussels 4, you've got to put a clause in your will that cite that clause, the Brussels 4 EU regulation. And you've got to specifically say that you elect, you South African national, and you elect your country's legislation to apply to the property in Cyprus.
Okay.
Right?
Very specific.
It's very specific, and if you do, that will apply. But then you're still potentially going to have to appoint an executor in that jurisdiction. Now, the one client we would test, their executive fee was 7% of the value of that property.
Oh, my goodness.
It's nearly double our rate.
And then the South African executor will also levy a fee on.
Correct, depending on how you get these wills to talk to each other, right? So, and if it's a 20 million euro property, which was quite huge, it's a huge amount. So if you start looking at those costs, then you've got to say, maybe it's not worthwhile to transfer to a trust because your executive fee, those costs might be more than your potential income tax from interest on a loan.
So then it's more worthwhile to follow civil law regulations.
Not even civil law. So they will still have to transfer the property. They still have an executor appointed in that jurisdiction.
So what would the solution be?
Take it to a trust while you're alive.
Okay.
Because, I mean, a 7% executive fee plus potential 3.5. Why do you have the asset then? Yeah. So what's left for the children?
It's illiquid. Yeah,
it's illiquid.
Okay.
Yeah. So you can see there's a lot of consideration one needs to do.
Yes.
Yeah.
So just from the wall, no right or wrong answer, but no matter which one you do, you have to make an informed decision and make sure you've got the right people involved. Because also if you got an executor in South Africa that has got the resources and the connections in the rest of the world to appoint agents to act on their behalf, or where your foreign appointed executor is used to working with South African executors, the process it's still going to be cumbersome, but at least you know what to expect and it can have the best outcome, rather than appointing people that don't know about each other and have never worked with these type of cross-border estates.
100%. And if you choose a good executor, I mean, if like Momentum, you also will you can negotiate maybe better on a holistic scale.
Yes.
As necessarily your own accountant, because it might be a one-man practice versus a corporate giant. So that will give you a bit of more leeway.
Yes.
And you kind of, in that context, you need that, especially with global assets.
Yes, and then obviously putting on top of that, we've got assets in other countries. The slightest tax also now becomes relevant.
Correct.
And that puts another administrative spoke in the wheel that can need liquidity once again, and often not possible to get it out of the asset that's in that jurisdiction because either it's immovable property or sometimes I've heard somewhere that they said the authorities were not willing to give them access to the actual investment until they paid the tax. So you physically have to nearly take the money from the South African estate, pay the tax to get the asset to be released.
Yeah. And it all goes back to liquidity, right?
Yes.
If you don't have liquidity, you end up selling your assets, or you need to go borrow from a bank, get yourself indebted to get those assets. And then do you really want that house after all that illiquid as all the share portfolio in America? So it's and I think a lot of people that's not in the financial advising space don't always think about liquidity.
No, I don't think they do. And they don't consider the impact of not having it, which is why we are here and having these discussions. Just on CITES and ease of administration and admin costs, maybe worthwhile mentioning MWI and the product choices that people make. Yeah. So MWI is making it easier for clients to transfer wealth, even when they go into the global investment, which is not in a wrapper. They've streamlined the process to bypass Guernsey probate if money goes to a South African estate account, so making it much easier for clients than it was in the past that I had to go through probate and then appoint someone there to administer and go through the admin process. And then obviously the endowment is always an option because first of all it blocks the CITES tax because the death of the client has got no impact on the underlying assets, and the smooth transfer of the asset because of beneficiary or successor contract owners just makes it possible. So from a succession point of view, if you're looking at investment, obviously the product that is used can sometimes solve all these problems.
No, 100%. And it is also a combination of that. So I had a query from one of your advisors. So he currently in endowment offshore, and he was 100% that was his right strategy. But now all his children are sitting in the UK.
Okay.
So his option is now to go to your normal holding, but don't go now direct equity because then you go into the CITES field. So ideally would want to get outside of endowment because your proceeds in the UK is going to be taxed as income tax.
Okay.
But then look at the alternative structure on a different platform and then work out a different strategy. Even if you didn't go to a trust, because in the kids in the UK, they'll still be taxed from distributions from a trust, potentially within income and capital, as opposed to the proceeds from endowment. In that case, it will be taxable as income. So you got to look at everything very carefully.
Actually got this as a topic for maybe one of our next Global Citizens, is to actually go into a bit of the jurisdictions and the trust as a vehicle and also as the products and the impact thereof.
Yeah.
So looking at successive transfers and the impact that has on wealth preservation and wealth transfer, I did a calculation. And I said the 100 million client that we spoke about earlier, he dies today, the money goes to his heirs, and then 20 years from now, the heir basically dies, and then it has to go through the whole process again.
Yeah.
So the numbers really speak for themselves. Where the heirs of the second transfer could have ended up with 319 million, they end up with 199 million because of the addition, the second layer of costs. So something that can be prevented if we do proactive planning. And that is where I think the freezer trust can come in, that you mentioned earlier.
Definitely, because the cost from yourself to your children, or the cost from yourself to the trust is the same, but then with the trust it stops.
Yeah, so you only have the first instance of costs. You don't have that second layer of costs.
Correct.
Now, the freezer trust is often also referred to as a dormant, or I've even heard bottom drawer trust.
Bottom drawer trust, and I think it's marketing, right? They all call it something different, all these different providers, but it's really a trust we set up now, and it is sit. You literally just let it sit. So it waits for being funded at somebody's death, normally through endowment type of policy.
Okay.
Yeah.
So I know a lot of the foreign trust companies do. You can set up a trust, you will pay a fee to set it up, and you will pay a fixed annual administration fee to keep the trust alive, because obviously there's still trustee compliance and compliance and admin that needs to be done. But other than that, the trust is really frozen in time, and it's a trust in waiting.
Yeah.
Maybe we can do a new term. And at that time, you can obviously eliminate the entire total cost of the second transfer. So ultimately protecting the wealth for the people that you intended for. And what I like about the trust option is, we spoke now, certain jurisdictions look at certain structures or products differently. If you use the foreign trust, the money will go there upon the first death, and then the kids and the trustees can obviously consider, will this trust work for us based on the jurisdiction that we are in? Because obviously some countries are also not really favorable of offshore trusts, and they tax them, and there's some jurisdictions that don't even recognize them. So then they can at least say, the trustees can then say, okay, in your jurisdiction, this isn't going to work, so we're going to base the money in you, and you must go and do with it as you please.
Also, what you can think about is not trust don't always have to be in a tax haven. I mean, that's first price. But if all the children are in Australia, for example, or in America, there's nothing that prevents you. I mean, America, there's actually no solutions. But if it was, for example, Australia, you can actually create a freezer trust in Australia as well.
Yeah, that's true.
Because with most of these countries that's so against trust and tax avoidance, they like their own.
Okay.
So if it's an Australian trust, okay, you don't have donations tax, you don't have estate duty in Australia, but you still want to protect the money. And that's ultimately the point of having a trust, is to protect that wealth so it can go more than 2 generations, especially the type of money we're talking about here. And it can go. So the first one creates, the second one is aware, the third one starts getting, and their kids, they forgot great-grandfather now that made the money, and they will just blow it if you don't take care.
But at least there's still a discussion to be had because it isn't a trust.
Yes.
So if they want to take it out, someone's still going to have to
There's a little bit
discuss
of
it with them.
control. There's somebody that's objective and independent. They're not going to block the transfer of money, but they will make sure that it grows and it's managed as opposed to being gone within one generation.
Yeah. I think in the end, there's no one size fits all.
Yeah.
And as we said at the beginning, maybe giving information so that people make informed decisions. And we constantly have to review because circumstances change. Clients are, just like money is fluid, clients and their families are, they moving abroad, they're living in different jurisdictions at different points in time. And we have to make sure that we keep that into consideration when advising. So, as we said, to advise a global family is becoming a challenge.
It's very much so. And I mean, this flying up this morning from Cape Town, there was a guy sitting next to me from Australia. So he's South African going to Australia, and he's coming home every year just to see, because his parents are still here. And now he says every year since he came back, he wanted to go back to Australia. But this time it was so hard for him to leave South Africa. So now he was probably, I would say, 2 years from retirement age. So as much as you can do a trust now, you don't necessarily want to terminate it. You've got to look at different strategies because a lot of them leave
and then come back.
And then eventually come back. When you've made your money, you want to come home. And I see it with a lot of people. South Africa is still a home. Because lifestyle and the warmth of South Africans is still drawing people back.
Yeah, that's true. And that's like when you're externalizing the funds, you're incurring the capital gains tax, when you cease your tax residency, when those expenses have been paid, they've been paid. So even when you come back, you're not going to get a refund. So making sure when you're making the decisions, you keep that in mind, that it can be a possibility.
100%.
Madeleine, I think we've come to the end of our time. And I think we've had a very interesting discussion and definitely opened a can of worms about the taxation of certain products in certain jurisdictions that I think we need to delve a bit deeper in possibly our next edition of Global Citizen. But for today's contribution, thank you very much for joining.
It's a pleasure.
And for all our viewers, thank you for joining us as well. Once again, feel free to ask questions and we'll do our best to answer them. And have a good day.